Hey everybody, this is Jake here with the Dividend Growth Investing channel. Welcome to all the new subscribers. If you're new to the channel, on this channel I talk about growing passive income or cash flow through dividend growth investing. And I'm very transparent. I share my portfolio here on YouTube, and I document my journey to financial freedom. I mean, that's what the channel is all about. And the demographic or the people that I'm addressing in my videos are really newer or beginner investors that are really interested in investing in a dividend growth strategy. And in every single video, I try to share an update on my portfolio, where I'm at. What you see in front of me is my M1 Finance account, as well as I like to talk about different topics that are interesting to me. And there's really no particular order. I just kind of share different topics as I go. And in today's video, I want to talk about the portfolio. I'll leave a timestamp in the description below if you want to jump ahead to just the portfolio. But the first part of the video, I want to talk about Dave Ramsey. And I want to talk about graduating from Dave Ramsey. And what I mean by that is, for example, here in the United States, we kind of have that culture of, you go to school when you're young, you graduate from junior high into high school, and then you graduate from high school in a lot of cases and go to college. And then from college, you then go out and you have your first job. And when you have your first job, you're graduating into life, right? And that's kind of that society that we have here. And what I want to talk about is graduating from a Dave Ramsey approach to investing to a dividend growth investing mindset. Right? And that's what we're going to talk about in today's video. And I want to talk about as well as why I believe that Dave Ramsey at heart is actually a dividend growth investor. So stick with me here and I'll share exactly what I mean by that. But if you're unfamiliar with Dave Ramsey is notorious for his 7 baby steps. Now, it's important to understand that Dave Ramsey is really addressing the masses. He's talking to people with a lot of consumer debt, whether it be cars, credit cards, student loans, whatever it may be. He declares war, or that debt is the root of all evil. All right. And so here are his 7 baby steps. And I think generally that they're sound advice. I mean, building up an emergency fund, I don't think anyone could dispute that. I think it's very, very important that you do that. I think he talks a lot about that snowball effect. And Dave Ramsey, I think if you're unfamiliar, he does recommend one investing strategy or one investing approach. And his philosophy is investing primarily into hyper-growth mutual funds. And mutual funds, and this is the interesting part, and I want to share a clip from Dave Ramsey himself on exactly what that means. But essentially here it's, Dave Ramsey is all about getting out of debt, investing your income, and not just for the short term, but for the long term. And so Dave Ramsey, to understand that, he's talking, when asked, okay, well, what kind of diversification should I have in my investments? This is his clear-cut answer. Whenever Dave Ramsey talks on his podcast or has visitors or somebody on his show, he always talks about investing in these four categories: having a portion of your income or your diversification in international mutual funds, or mutual funds that have an emphasis on international companies, as well as growth in income. Now, if you're new and you're unfamiliar with growth in income, it's pretty simple. Growth is, for example, your companies like Amazon, companies that are really trying to scale and they're really trying to innovate and grow. Income would be more of an established company like a Coca-Cola that is paying out income or dividends. And the next one down here on the bottom right, growth, this would be, for example, your Facebook. Companies that are growing, acquiring other companies. And aggressive growth, this could be, for example, your Tesla. This could be a software company like ServiceNow, Adobe, these other companies that are really, really in hyper growth mode. Okay, so let's hear from Dave Ramsey himself.
The mutual funds that I buy outperform the S&P 500. And they're really not that hard to find. A lot of mutual funds don't outperform the S&P 500. So if you're going to buy that, well, that'd be dumb. Just buy an S&P 500. But I buy mutual funds that outperform the S&P 500, and my portfolio mix that I just outlined is pretty much always beats the market.
All right, so it's important to understand. Now, Dave Ramsey is talking about beating the market. And this is really important because when Dave Ramsey talks about investing for retirement, there's really two schools of thought. There's the 4% rule. The 4% rule means that you're investing so that you can gain a huge chunk of capital, whether it be $1 million, $2 million, goes on and on and on. The idea is that you're going to take out 4% of your total account every single year. And that is supposed to outlive you. The other school of thought is to live off of the income. And the income would be, for example, the dividends. So here, you're not touching the capital. Now, Dave Ramsey is talking or addressing individuals with the 4% rule. On my channel here, I'm talking about the other alternative, which is living off of the income, the passive income, or the dividends. And you're not touching the capital. And this is why I say, okay, when you invest in this style, you're investing for generations to come because you're maintaining that capital. Now, let's take a look at another clip from Dave Ramsey on how he picks his mutual funds.
If you're buying good growth stock mutual funds and you want to beat that, you want to buy a fund that has a higher average annual than the S&P over the given period of time.
All right, so Dave is really talking about, okay, we want to beat the market. This is what he's really teaching to his viewers and his listeners. And Dave actually never recommends individual mutual funds. And there's a couple reasons likely, and I believe it's probably most likely due to liability. He doesn't want to be liable. Somebody said, okay, hey, you told me to invest into this. I did it. Well, it's just tanked. Another reason could be, for example, reputation. He doesn't want to have the reputation that, well, he recommended this and then the market took a dive, and he doesn't want to be associated with that. And so he's very conservative when it comes to recommending individual mutual funds. However, he does say he's looking specifically for mutual funds that have beat the market. So let's go ahead and let's take a look, for example, at Vanguard's actively managed mutual funds. Mutual funds are different than index funds. You've probably heard that before. A mutual fund is an actively managed fund from fund managers. What that means is they're buying and selling in and out of companies throughout the year, whereas an index fund is the fund manager sets it up at the beginning of the year and they let it ride. They're not actively managing it. They're not actively taking it in and out. Some of the most popular index funds would be, for example, your SPY. It tracks the S&P 500, VOO from Vanguard, the S&P 500. Those are just a few examples. But the Vanguard mutual fund, so here, these actively managed funds, what Dave Ramsey is saying is, okay, well, you should then just go and look at the actual returns here. Now let's go take a look at some of the U.S. stocks. And you can see here the year-to-date performance. This is not including dividends. This is the yearly, so AAR, the average annual return, the 5-year annual average return, the 10-year, and then since the inception. The inception is when the fund started. And you can see here, for example, in this one, it started in 2005. And so what you're going to do is you're going to say, okay, well, as we know, Dave Ramsey says, okay, well, you shouldn't look in the short term. We should look the time span out as long as we possibly can. And so what I'm going to do is I'm going to look at since the inception. So when it was first started. And so all of these, for example, these large cap are just right around where the overall market has been. And so Dave Ramsey probably is not referring to these mutual funds when he's recommending he invests into mutual funds that beat the market. Now, for example, if the S&P 500 is averaging right around 8%, this is where we want to start looking. Okay, well, there's a mid-cap growth fund here from Vanguard that has 10%. It's averaged 29% year to date. That is beating the S&P 500. So if that's the case, just marginally, not very much because of how the market has performed this year. But if we were to take a look at this mid-cap growth mutual fund from Vanguard, let's take a look and let's see it. So if we were to invest into this is a massive dividend growth mutual fund. Now, it's important to understand, now this is the rate at which this mutual fund or the companies held within this mutual fund are increasing their dividend year over year. Now, it's important to understand that you're going to get a very much lower starting yield. Like this is very, very low. However, if you're in your early 20s and you have time for this to grow, you're going to have a lot more in your account when it comes time to retire because, conversely, comparing it to a growth rate of 4%, for example, if it were to average 4%, because you have time for it to grow. Now, if you are nearing retirement, this is not going to be an ideal mutual fund to own because it has if you were to live off the income or the dividends. On the other side, if you were to live off of the 4% rule, where you're selling 4% of the capital every single year, this would maybe be something to look into, right? But this is a dividend growth mutual fund, right? And it's beating the market. It is absolutely beating the market. So this is one example of how you could follow the approach that Dave Ramsey talks about on his show, right? So what I want to talk about next is something that when I first started reading about Dave Ramsey, I actually read one of the first financial books that I ever read was from Dave Ramsey. And when I initially read it, because I'm not normal. Like I don't have a lot of consumer debt, normal by standards of here in the United States, where normal is to have a lot of consumer debt, student loan debt, and so forth. So by that definition, I am not normal. And Dave Ramsey does not like credit cards. And when I first read his book that he said that I should first stop using credit cards, I thought, well, on my Capital One card, I'm getting 2% back on everything that I purchase, and I pay off the payments every single month. I'm not paying any interest. And so it really got me thinking, right? And so if you're investing based off of the approach from Dave Ramsey, this is kind of food for thought to start, thinking about it. Now, one thing that I do want to mention that is very, very important are the costs associated with actively managed mutual funds. Now with Vanguard, they are very well known for their low costs. I mean, that's what popularized them here in the 80s, the 90s, and as recent because of their low costs. If you were to go with a traditional mutual fund, you're paying an expense fee of around 1% to 2%. Whereas with these, if you were to look at the different mutual funds here, the expense ratio, they're very, very low in comparison to other actively managed funds. I mean, these are very low. Okay, now I want to hear a quick clip from Jack Bogle on the importance of fees. And when I think of mutual funds, there's a direct correlation with the associated fees.
What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us.
All right. So this is what I'm talking about with graduating from Dave Ramsey. The fees associated with this are real. Jack Bogle, who we just heard from, the founder of Vanguard, really outlines the importance that the fees play when looking at this over the long term. Now, Dave Ramsey, I think he has a lot of value to add. But coming back to what I was mentioning earlier, I think for new investors that are, they've never really done it themselves and they're consumed with debt, I think Dave Ramsey is a great way to start, a great place to start. But then once you've gained control of your finances, then I think graduating from this approach to a dividend growth mindset, a dividend growth approach is going to yield a lot better results in the long term. Now, this is obviously dependent on who you are, where you're at, and your individual situation. If you're in your early 20s, this is what where the power of compounding is really going to work in your favor, especially if you take control of it yourself. If you're investing into high quality, not mutual funds, but index funds that are growing their dividend year over year, you're going to have exponentially higher returns had you had stuck with an expensive mutual fund that in some cases may not always beat the market. And I think those are really the things that you really have to consider when looking at this. Now, with that, everybody, I want to go ahead and I want to jump back into the platform, back into the portfolio. I hear all the time in the comment sections of whether it be my own videos or other YouTubers here that talk about dividend investing, whether it be PPC Ian or Joseph Carlson or others, there's always the topic of, well, why would I invest into dividend stocks when I can just invest into growth stocks? Now, I think this is really important, but I think it's important to also understand that I also invest into growth stocks. Growth stocks, just because they're growth stocks, does not mean that they are dividend growth stocks. Now, when I talk about growth stocks, I'm really talking about companies that are growing 10, 20% year over year. Not a lot of companies can do that. Not a lot of established companies like a Coca-Cola, a Pepsi can do that. A lot of technology companies are able to do that, and a lot of them reinvest their cash flow into their business or expand into new markets. However, there are a few growth stocks that I am invested in that are considered dividend growth stocks. For example, one of my favorite dividend growth stocks is Microsoft. Microsoft is by definition a growth stock, but also a dividend growth stock. If we look at its dividend here, it has a fairly low starting yield of just over 1%, but the important thing is the dividend growth. If we look at the growth rate at which it's growing its dividend, Microsoft is growing its dividend year over year, Microsoft is growing its dividend 14% over the last 10 years. This is huge. This is way outpacing inflation. If you were to invest in a Microsoft, you're going to, yes, have capital appreciation, but you're going to also have appreciation in your income, your dividends. Okay. Another example that I have in my portfolio would be, for example, Apple. Apple is a growth stock. Apple also pays a dividend. It pays a little bit of a smaller dividend compared to Microsoft, but it pays over 1%. And this is based off of the share price. And as we know this year, Apple has just exploded this year. And Apple has not paid a dividend for all that long, only 7 years. And over those 7 years, it's averaged over 10% in increasing its dividend. So yes, I invest into growth stocks, but dividend growth stocks, companies that are growing their dividend. And that's what I love about it. I get the best of both worlds. I get the capital appreciation as well as the increase in the cash flow. I mean, that's huge. Okay, and so that's what I'm talking about here on the channel, about growing your dividend. And when we look at the capital appreciation, if we go back here to the overall portfolio, the overall portfolio since May of 2019, this year, I transferred over a portion of my Robinhood account into my M1 Finance account. And since May, I've seen over 2,000 in market gains. This is capital appreciation. I don't get to realize these gains until I sell them. But this is not why I'm investing. I'm investing for the earned dividends. And of this $2,650 that I have in gains, $453 are earned dividends. This is cash flow. This is cash in my pocket. I see this as additional paychecks, just like my 9-to-5. Where the difference is my paycheck from my 9-to-5 is active income. My dividends, this is considered passive income. Okay. And with M1 Finance, I get paid almost every single day, because I take a little bit of an unconventional route. I have just under 100 individual holdings that I have in my portfolio. Now, I don't say that this is the right approach for everyone. I want to be very clear. In my Roth IRA, I have high quality broad-based ETFs or index funds in my account. For example, I have VTSAX from Vanguard, the total stock market fund. I have VIG in my Roth IRA, the Vanguard Dividend Appreciation ETF. So I am invested into ETFs, but here on M1 Finance, this is just my portfolio with primarily individual companies. And the thing that I love about this approach is every single day, for the most part, almost every day, every single week, I'm getting paid dividends from these wonderful businesses. Companies like Southern Company, Honeywell, Boeing, UPS, Visa. And the thing that I love about it is I'm not reinvesting directly back into Southern Company. For example, Wells Fargo paid me $3.47. Those $3.47 did not go back only into Wells Fargo. What they did is they went back into my other holdings, and I'll show that here just in a second. So for example, if I were to look at Wells Fargo, pay me $3.47, it was then used to invest on December 3rd, because every single day I transfer $50 into my account. I have it on autopilot. Every day I transfer $50 from my bank account and then it invests into my underweight holdings. And on December 3rd, $50 plus the $13 that I got in my dividends were invested into these companies. Companies like Dominion Energy, Duke Energy, Texas Instruments, another growth stock, you could say, a dividend growth stock in TXN. And this is how I have it set up. And this is what I love about M1 Finance is I set up my portfolio, I set up my target allocation, and based off of my target allocation, M1 Finance is going to automatically invest in my underweight holdings. And I can set up my slices exactly how I'd like. If I were to look into the material slice, for example, I have companies like PPG, International Paper, Sonico products, and the list goes on. And you could do this as well if you're a new investor and you don't want to spend hours on hours of research. You could pick one or two great high growth dividend companies and put them into your portfolio. You could also invest directly into an ETF. You could do an ETF and put that into your a slice setup just like here, where you get an ETF just for industrials, just for consumer discretionary, for example. And so this is how I have my portfolio set up. And the thing that I love about it is, I can up the target allocation based off of, whether it be bias, because I absolutely love Disney. My wife and we just signed up with Disney Plus. That could be, we go to Target every single week to go shopping. I mean, these companies that I have in my portfolio, I do for most of them, I do have a connection. I am a consumer of them. Not all of them, but a lot of them. And so this is how I have it set up. Now, once again, just because, I invest into dividend paying companies, it does not mean that I'm not investing into dividend growth companies. And the thing that I love, these dividends that I'm getting paid every single week, every single month, every single quarter, as I reinvest them and as I transfer more money every single day, that is going to create that snowball effect. And that snowball effect, when it comes time for me to retire, I'm not going to be relying on selling off of my capital, through the 4% rule that I talked about earlier, but rather living off of the income, the passive income of these dividends, right? So that's how I have it set up, everybody. Let me know what you think, right? This concept, this idea of graduating from Dave Ramsey, I'd be curious to hear what your thoughts are on it, what your opinions are, if you've been a follower of Dave Ramsey in the past, or if not, or what your strategy is. Be interested to hear your thoughts. Once again, if you're new to the channel, I'd invite you to subscribe, like the video, and I will catch you all in the next video.